Hi everyone, this is Nancy Godrad. In this session, we're going to go over Chapter 9, Objective number 1. I will have a separate video for Objectives 2 and 3. We will not cover in this course Objectives 4 and 5, and therefore there will be no homework questions or exam questions regarding those. You can study these objectives on your own, and if you have any questions, you can always email me. The first thing we're going to cover is the definition of plant assets. Plant assets are those resources that have a physical substance, meaning that you can see and touch them. They are used in the operation of the business, meaning that the company is not intending to do not intend to sell them to customers for a profit because they need them to run the operation. The useful life of these assets are for a number of years. The other terminology used to refer to plant assets are property, plant, and equipment, which is abbreviated by PP&E, plant and equipment, and sometimes fixed asset is used to refer to plant assets. So we need to also know about historical cost principle, or for short, cost principle, which says that the plant asset should be recorded at cost. And we're going to go over what is cost. Cost consists of all the expenditures that the company pays for to purchase the asset and make it ready for its intended use. And we're going to go over each one of the plant assets. The first one is land. When we buy land, the purchase price is included in the cost of land as well as closing costs such as title and attorney fees. So what are closing costs? Normally when the buyer and seller get together, an unbiased third party is used to hold the cash and make sure the title of the company, the ownership of the company really belongs to the buyer. And sometimes we want an attorney to take a look at our contract, so the fees are included in the cost of the asset, in this case land. Also, real estate broker commission is included. Now, what is accrued property tax that is included in the cost of land? Those are a property tax that the seller hasn't paid because they are old and they have been overdue and the seller hasn't paid them. So when the buyer pays them to acquire the land, that is also part of the cost. Now, if there is an old building on the land and our intention is to get rid of it and build a new building, the cost of demolishing or raising that old building meaning minus the proceed from salvage material is included in the cost. We're going to go over an example to demonstrate that. Let's say Hayes Company acquires real estate, a land, at a cash cost of $100,000. And the property has an old warehouse on it, and the intention of the company is to get rid of it and build a new building or a warehouse. Now, the cost of getting rid of that old building is $6,000. Why? Because we had to pay $7,500 to get rid of the building. However, we were able to sell some of the salvage materials, such as, let's say, copper piping for $1,500. So $7,500 minus $1,500, the $6,000 net will be included in the cost of land. They also paid for attorney fees and real estate commissions. So therefore, the cost of the land would be the $100,000 plus the $6,000, $1,000, and $8,000, so total $115,000. Now, because they paid cash, we're going to debit land and credit cash for the $115,000. So that would be the journal entry. Now, land improvements are different from land. Those are a different asset. and those are additions that are structural additions made to the land. And normally some of the examples are driveways, parking lots, fences, landscaping, underground sprinklers. They have a limited useful life, and so therefore we're gonna, while they are being used, part of the cost of the land improvement will be expensed each year over its useful life. By the way, land under generally accepted accounting principles does not get depreciated, meaning that we never expense the land until we sell it. Even when we sell it, we're just going to get rid of the land itself and debit cash that we got from the sale. So we do not depreciate land at all. The next property, plant, and equipment is buildings. The cost of building, either to purchase or construct, include the purchase price, again, closing costs, which would be attorney fees, title insurance, and broker commission. Now, if we need to remodel or replace or repair a part of the building, we will include those as well before we, and these are done before we occupy the building. Now, if we're constructing the building, then the cost includes also the architect's fee, the permit, excavation cost, and also if we need to level the land to build the building, that is also considered cost of the building. So the next plant asset is equipment. The cost include, again, the purchase price, if we pay sales tax on it, cost of printing our logo, which is called lettering, on that for the first time. If we need to get equipment from a different location, the shipping cost or freight cost is included in the cost of the equipment. When we pay insurance to make sure nothing happens to the equipment during its transit, meaning it coming from a different location to our location, it is included in the cost of the equipment. However, remember, the cost of accident insurance that we pay every year is not included in the cost of equipment, same as the cost of DMV or license fee paid every year, and especially at the when we buy the equipment. Now, the other expenditures that is included in the cost of the equipment is assembling, installing, and testing the unit to make sure it's working. Now, let's go over an example. Lennard Company purchases a delivery truck at a cash price of $22,000. Now, other expenditures are sales tax, printing and lettering to put the logo on that equipment, and then license fee, which should not be included in the cost of the equipment. We need to expense that, and then a 3-year accident insurance policy. Again, we're not going to include that in the cost of the equipment. What would that be? That would be an asset called prepaid insurance. We talked about that in chapter 3. So therefore, the cost of the truck is the cash price plus the sales tax plus the painting and lettering and the brokerage. Actually, we didn't pay brokerage fee. This is not a land or equipment. So the cost of delivery truck is $23,820. And therefore, we're going to debit equipment and credit cash for $23,820. So equipment, and then we have license expense and prepaid insurance. So the total cash we paid would be $25,500, of which $23,820 is for the truck, for the equipment. Now, there are expenditures during the useful life of our plant assets that falls into two categories. One is ordinary repairs to maintain the operating efficiency and life of that asset. For example, if you have a truck, when you change the oil and filter, that is considered an ordinary repair because it maintains the efficiency of that equipment. So therefore, we're going to debit an expense called maintenance and repairs and credit cash or accounts payable depending on the situation. Now, these type of expenses are called revenue expenditures. Why? Because they're going to go against those expenses reduces revenue. Now, if the money that we spend is for increasing the operating efficiency or productive capacity or life of that plant asset, then we call those capital expenditures because they are really an asset. So we debit that asset depending on what we spend, and we credit cash or accounts payable based on the situation. What are the examples? Let's say we add a new wing to a building that we have, that becomes an additional building. Or replacing an old engine for an equipment with a new engine, then the cost of the equipment is also increased. I'm going to stop here and go over the other objectives in a separate video. As usual, if you have any questions, please email me.